Wednesday, August 2nd, 2017, Monaco 64, home of alternative economics and contrarian views. I'm going to be looking at different kinds of charts for price action. I'm going to look at the Dow Jones Industrial Average, mostly at that, going back all the way to 1920. And you will see how different these two charts look. I'll also look a little bit at the Dow Gold Ratio, which I think is quite important, and a couple of charts of gold, a bit quicker than the Dow. Basically, I'm going to be looking at the logarithmic chart and the linear chart or arithmetic chart. And I would say that the majority of people, especially, amateur investors, if you like to call them, not professionals, and even professional investors and traders, they look a lot more at the linear price chart instead of the logarithmic price chart. And I've gone to Wikipedia here to give you exactly what the difference is. So it goes on to say here in Investopedia, a linear price scale is plotted on the side of the chart so that there's an equal distance between the prices, and each unit on the chart is represented by the same vertical distance on the scale, regardless of what price level the asset is at when the change occurs. By contrast, a logarithmic price scale is plotted so that the prices in the scale are not positioned equidistantly. Instead, the scale is plotted in such a way that two equal percent changes are plotted as the same vertical distance on the scale. And the main reason I want to look at this and look at the Dow is that even though I do think the Dow is, overbought and overvalued, the stock market in general, financial assets, I think we could still go further higher, quite significantly higher in terms of nominal amount or on a linear scale. But you will see that logarithmically, it's not out of the realms of possibility that it could do. So first of all, I'm going to show you a normal chart or linear chart, the chart that most people look at of the Dow Industrial going back to 1920. And it's a quarterly chart. And it looks like a massive blow-off bubble. And I'm not saying that the Dow is in a bubble right now, but look at this. I mean, from 1920 to about 1960, we hogged that zero line most of the time, and it actually only started accelerating in the mid to late 80s. The Dow Jones Industrial Average, and since Greenspan came on, Mr. Bubble, and his successors, Bernanke and Yellen, the chart looks massively like a blow-off top. And I'm not saying it isn't a blow-off top, but I want to show you now the logarithmic chart of the Dow going back to 1920. So this is, the distance between the prices are, not the same, but they are the same percentage-wise. So you can see there from 20 to 40, that's doubling. And then 40 to 100, that's 250%. The distance is not the same, it's by percentage. And I've taken the high in the Dow, which was in 1929 in the third quarter. The high was 386.10. And you can see how that bull market in the 20s was quite severe, because even in a logarithmic chart, it looks quite extreme. So the high was 386.10 in 1929, and then the low was in the third quarter of 1932 at 40.56. And as you can see, I've drawn basically 3 trend lines, long-term trend lines, and I've also drawn a shorter-term trend line taking the high in 2000 and the high in 2007. And I've looked at the chart here, and the very top of the trend line, near where we are right now, that is the equivalent of around just under 28,000 in the Dow. And now with the Dow around 22,000, that doesn't seem so outlandish. But as you can see, it's not, percentage-wise, it's not a huge move compared to what we saw in the 1920s. This has been more gradual, since the bottom in 1932. What else? The middle line, which seems to be, the line we broke out of, in the mid 1990s when the tech bubble started, the dot-com boom. That line is around, let's have a look, 14,200, which also happens to be very close to the top in 2007. So very interesting there, that middle line. That could be a target, 14,200. And then the bottom line is basically around 6,500. That would be maybe, in the next quarter or next year or so, roughly around 6,500, which happens to be close to the 2009 low, around 6,500. And then the other trend line, the shorter term trend line with the top in 2000 and top in 2007, that comes around 18,000, which is pretty much where we broke out of after the election last year, 18,000. So very interesting. Where are we gonna go? I mean, we could go to 28,000, or we could fail and drop back down. I mean, the move in 2007, we didn't go back up to the top of the top trend line, and we dropped, below the middle trend line. We could go up to 28,000, or we could turn around right here and drop below 18 and then go test 14,200 and maybe even go back down to, 6,500. But, don't be shocked if we go to 28,000. As you can see, in this logarithmic chart, it's not out of the, it wouldn't be like out of the ordinary for it to do that. So now I want to talk a little bit about the Dow Gold Ratio, because it's a very interesting ratio, a very important ratio in my opinion, because it's basically, the relationship between the corporate America and the value of money. And why do I say the value of money? Because gold is still money. It is the premier monetary metal. It's the, huge reserve. Central banks still keep gold. And as Jim Sinclair says, if you have to balance sovereign books, you're going to have to use gold. So it's very important, that ratio. So before I go to the ratio, I think I've done a video before about why gold could go to 11,000 and it wouldn't be a huge move. And I showed a logarithmic chart, this one here, quarterly, going back to 1970. And I said that if we had the same move that we had from 1976 to 1980, gold would be going to around, it could go to around 11,000, in terms of dollars. And then I'll just show you quickly here a linear chart of gold, same time period. You see, from 2000 to 2011, it looks like a huge move. The correction looks quite sharp, but not as sharp as in the logarithmic chart. So back to the Dow Gold Ratio. Well, in 1929, when the Dow topped at 386.10. The price of gold was $20.67. It was fixed, the ounce. And the ratio got to 18.679 on that top. So you could buy almost 19 ounces of gold with one Dow. And then at the bottom in 1932, the Dow got down to 40.56. The ratio, the price of gold was still 20.67 in the third quarter of 1932. And that ratio got to 1.96, so let's say 2 for all intents and purposes. And then we had the next credit bubble or credit growth from 1932 to 1966. The Dow topped at 1,001.11, and gold was at $35 an ounce at that time. So the ratio got to 28.6. And then we had another, credit implosion or correction or reset, if you want to call it. And gold traded above 800 in January 1980. The Dow was around 800 at that time. So the ratio got down to 1. So 2 in 1932, 1 in 1980. And then we've had another credit bubble. And I would say that the credit bubble topped in terms of gold in 2000, in the first quarter, when the Dow reached 11,750. Gold was around $280. So that Dow Gold Ratio was around 42. And since then, we haven't gotten back above 42. But right now, with the Dow around 22,000 and gold around 1270, that Dow Gold Ratio is 17.32. And looking at those charts and, looking at what the Dow could do, I know we could still go up, but if we are going to see a correction or a reversion to the mean, as Greg Marino calls, that mean could be 14,200, but it could also mean that we could go down to 6,500. And with gold maybe going up to 11,000, we could get actually go through the Dow Gold Ratio, whereby the ounce of gold will be worth even more than the Dow. And it would make sense because since 1980, this has been the biggest, well, not 1980, since 2000, even though we've had a huge, credit boom, the Dow Gold Ratio is still going down, which means we're still correcting. We're correcting actually the 35 or 36-year bubble in the bond market. And it is the biggest bubble, of the last 100 years of the central banking era. So I would say that the reset or the correction will be, in terms of gold, will be much more pronounced. We might not, collapse in the Dow to 1,000. I would say that 6,500 could be in the cards in the Dow, and then gold might even go up to 11, or it could go up to maybe it could go up to 6, but that would still be 1-to-1. But most probably, I think we're going to see, you're going to need basically two Dows to buy 1 ounce of gold instead of, one Dow to buy 1 ounce. These logarithmic charts are very interesting. And I think people just need to sit tight, be patient. Don't play the game if you don't want to get burnt. Or hedge your bets. Have exposure to the stock market, but also have some physical gold and silver to smooth out the big moves. So that's it. If you like this video, give me a thumbs up, share it, subscribe to the channel if you haven't yet. If you'd like to donate to my channel, there's some links below in the description as well. and I'll talk to you later. Bye.